infinite banking. In this module, you'll learn the concept of infinite banking and how to be your own bank.
Are you guys ready? Yeah, Brandon, you ain't said that.
Yes, sir.
All right,
Go ahead. We're waiting.
Yeah, man.
Yep.
All
I'm
right.
anxious.
We're
All
waiting.
right, check this out, man. So let's just imagine this is us right here. Now, y'all don't laugh at my drawings. I'm not an artist. But this is us, right? And every single day, every single month, we go to work and we make some money. Now, my question is, when we get that money, how do we receive it? Like, where does it go first?
Depending on what job you have and how you're earning that money.
You get taxed first.
Yep, it gets taxed. What's left over, what happens with what's left over? Where do you put
Then it go to your bank. Go to your bank.
Right.
To the bank.
Bam, your money going right here to the bank account, okay? And then it sits in that bank account. Then what happens with it?
Loses value.
Loses some value. But what else do you do from your bank account?
Pay bills.
There you
Pay
go.
money.
Bills. Pay bills.
What kind of bills do we got?
Mortgage, rent, utilities, car.
Car, utilities,
Groceries.
Internet. So cell phone and internet and apps and stuff.
Fun. Can't forget about fun, right?
Entertainment.
Every entertainment. Absolutely, right? Insurance. That's the bad kind of insurance. We talking about the good kind today, but we're going to put it as a bill. All right. Now, my point is, let's just kind of put some numbers to this, right? And let's just say, for example, that somebody makes $5,000 a month. That's their income, okay? We know up to this point that that money is going into their bank account once they get paid, right? And then from there, the question then becomes, how much of that is this person going to spend on their bills, on their lifestyle, right? Most people spend just as much as they pay out, or just as much as they make on bills. Less people save some of that money, right? So what I'm about to share with you guys today, you definitely got to be able to save some money in order to be able to make this work, right? But let's just say, for example, that these bills total $4,000 a month, right? So what most people doing is they're just paying their bills through their bank account. Now, my question becomes, when you put money into the bank account, do you at some point of time plan on going and getting that money out of it?
No.
You don't?
Because using a credit card is much easier than taking cash out and going to the store. And most places not even accepting cash no more. So no, the cash stays there.
Got it. Well, let me read. Maybe I could rephrase the question, right? Okay. So let's just forget about all these different bills. Let's say there were no bills, and you put $5,000 in the bank. What's our plan with it? Is it just going to sit there?
Oh, you're going to take it out and spend it.
Right. So my question becomes, did you give the bank your money or did you loan the bank your money? Because there's a big difference.
You gave them your money because you didn't qualify. They didn't give you a loan on that money. You just went and took it right back out. So you kind of gave it to them, and then when they pulled it back out.
I like that. So this is actually going somewhere. It's going somewhere. So let me ask you this: who said that? Nigel.
Yep.
It was Nigel. Nigel, man, if I come and ask you to borrow your car, do you expect me to give it back to you?
Yeah, you use the word borrow. So yes, I'm expecting you to give it back.
Okay, so when you give the bank $5,000, do you expect them to give it back to you when you want to go get it?
Yeah.
All right.
Right.
So we're not giving the bank. Well, technically, we are giving the bank money because they're not paying us anything to use it. For example, if you wanted to go buy a house, you need money to do that. Typically, you need a lot more money than what you have. So you have to borrow it from who? The bank.
The bank.
And does the bank give it to you for free or do they charge you for it?
They charge you.
Exactly, right? So they typically charge what, like 4%? Actually, that's low now. It's 5%, 5.5% for a loan now.
Personal loan? Is that personal loan? 5%?
Mortgage, right? So what I'm trying to get you guys to wrap your head around is when we go borrow money from the bank charges us interest. When we give money to the bank gives us what? Nothing. Absolutely nothing. So if we think about how much money we've loaned to the bank for free over the last 20 years, 30 years, 40 years, it can add up, right? Now, this is going to go somewhere. I want you guys to remember this. The most powerful asset that you have today is your income. It's you. It's your life, right? That is your number one asset outside of anything else, okay? So as you make this money, you need to save it all. Save it all. You want to get paid for using your money. So let's just kind of put some big numbers to this real quick. And everybody's money works this way. I'm not the only person. Okay. You got income. You got expenses. And then we got what we save. Okay. So let's say we make 50,000 a year. Let's say our expenses are 40,000 a year. And let's say we save 10 grand a year. Okay. So if we're lucky, we're going to take this 10,000, we're going to invest it, and maybe we can get like what, 15%, 10%. What would you guys say would be a pretty average rate of return if we invested it over the next 30 years?
It all depends what you're investing it into.
Mm-hmm. Got you. Okay. All right. Well, I like that, Leslie. What if it were you, where would you invest it?
I invested in myself, first of all, because if you keep the money in the bank, actually, your money is depreciating as we see right now. So and that's a tough question, where to invest it in. It's going to go back to yourself pretty much, no matter what you do in itself. Gotcha. Stock markets or crypto, any of that other stuff is something that I think you didn't include in there. If you're working at an institution, you're going to have to pay out your return. You have your investments that they're taking out, but these investment companies are taking a good portion of that out. Yeah. So it's tricky right now. That's, I guess, what you're going to try to explain to us, what to invest in or what not to invest in.
Oh, I'm not going to tell you what to invest in or what not to invest in. Okay. I'm definitely not going to do that.
Yes.
All right. What I am going to suggest is that the point is we should be investing in something. Yes. And typically, no matter what it is, we're gonna average a certain rate of return for that investment over a certain amount of time. If you buy real estate, it's almost a guarantee that their house is going to be worth a lot more 30 years than today than what you paid for it. All right. So that's technically an investment. It's going to increase in value over the time. Ronald said 10%. Ronald, that's a good answer, Ronald. Where'd you get that 10% from? I'm just
yes.
Huh?
Because I know stocks. They say that when you buy stocks, don't even think 10. They say think more like 7 if that's great. And I'm seeing right now I'm getting 5%. I understand what you're saying, and I know rent. When you build with rentals, is more like you can get like around 10, maybe 15.
Okay,
that's good. That's
gotcha.
Very good.
Got yeah, 10% is like crazy. That's good. And you're actually right. 10% is the average based on the numbers, if we're not accounting for fees and taxes and all that other stuff. So let's just say you get 10% on your $10,000 of savings for 1 year. How much is that? That's $1,000. Right? But we had $50,000 that we made. 40,000 we used to pay everybody else, the light bill, the insurance, the car, the home, et cetera, et cetera. Everybody getting paid on our expenses, right? Now, what if there was a way you can take this $40,000 and earn an average of 3% year over year on that? Can somebody do the math for me? 40,000 times 3%?
Hello?
$1,200.
$1,200. So my question becomes, which one would you rather have? 10% on the $10,000 that you save, or 3% on the $40,000 that you spend?
3% all day.
I like that answer, but that's not quite the answer that I was looking for.
I was going to go with the other option, 10% on what you save.
You are. I like that answer, but that not the quite answer.
Can we go with both?
There we go. Who said both?
Calvin.
There we go.
I was thinking both, and why not both?
Why not both? See, you see how our minds are trained to pick one or the other?
Mm.
You see what I'm saying? Why not both? How do you get both? Life insurance. Who heard that before today?
I heard it. I heard it from Christina.
There we go. So this is something I personally have been doing over the last few years. And I learned this strategy. As a matter of fact, I learned it from our team, Thrive Wealth Solutions. So I'm not even the person who created this strategy. I just was made aware of it. And because I've been in the industry for a while, I was able to take what I already knew, combined it with what somebody else taught me with a lot more experience. And I just been applying it to my life. And that's why I've been kind of sharing the knowledge, sharing the information with anybody who really listens. And that's how Christina and I met, right? So what I'm gonna do with you guys today is I'm just gonna show you an example, okay? Just an example of what a life insurance policy can do. We're not gonna get like into all the technical details, but I just want you guys to see bigger picture of how much money we leaving on the table by not using life insurance this way. Who want to leave money on the table?
Nobody.
All right, now.
Nobody.
Nobody.
Make
Nothing
sure
to
I'm on the
lose.
right
Nobody.
call.
Yeah.
Just trying to make sure I'm on the right Zoom call. All right. Now, hold on. Let me see if I can get this squared away.
You definitely on the right Zoom call. Everybody here is motivated and they building wealth. So they need to use these tools.
There we go. Oh, wait, let's pump the brakes a little bit. We don't want to jump into the numbers real quick. We want to give you some context. Okay. All right. So I want you to meet these are actually some of my real clients. This is Kenny and Michelle Bowers. They live in Texas. We got anybody in Texas on the call?
There's somebody in Houston.
Houston, H-Town.
I live in Houston.
There you go, H-Town. There we go. That's what's up. So Kenny and Michelle are some clients of mine. They actually started this policy last year, so they're coming up on a year. And I really like using their story because it's not like something like super crazy. Typically, when we have a conversation around cash value life insurance, which is what we're talking about today, it's typically thought like the common myth is that it's for rich people, right? That's usually what they say, oh, rich people got to do it. If you don't have a bunch of money, then don't even look at cash value life insurance. That's what they teach us, right? Well, I'm gonna tell you, I didn't have a lot of money when I started mine. Thank God I found this stuff. That's all I can say. And so their story, they're not like I would say balling out of control. It's 2-income household. They got 2 little girls, and they bring home $90,000 a year. All right. Now I know that does go a long way in Texas. Well, at least last year it went a long way in Texas. Now it don't really go a long way, really kind of anywhere with gas at $6 a gallon. Y'all feel me? Yeah. So money's getting eaten into, right? So essentially, they have a combined net income of $90,000 a year, $7,500 a month. Their expenses total $60,000 a year, about $5,000 a month. Sometimes it's more, sometimes it's less. It's just kind of like a ballpark average of what they spend on a yearly basis. In terms of assets, they got a 401. They both have 401ks. Kenny's getting a 3% match, putting in 6%. And so, we actually had him reduce his 6% down to 3%. Does anybody happen to have any idea why we had to reduce that 401k contribution down?
So he can allocate the funds to life insurance, I guess.
Yep, that's partially correct. It is gonna free up a little bit of money, right? But the bigger picture is diversification. How many people have heard diversification of your portfolio?
Yep, Christina told us.
All right. Now, how many people have heard about diversification of your taxes? Y'all remember the first key to wealth? Having our money in the right tax position? So 401ks are taxable accounts, right? So we get a tax break on it today, and we do something called deferred tax, right? So if anybody went to college and has student loans and you ain't paid on them yet, you're basically deferring the student loan payment. But does the student loan ever go away? Hell no, it don't go away. It just get bigger and bigger and bigger and bigger and bigger. And then at some point in time, you're gonna have to pay it, right? So same thing with a 401k. We defer tax to a later point in time. The tax bill gets bigger and bigger and bigger and bigger and bigger. Then we start taking money out of that account. We owe the taxes on the full amount of that account, or however much money we taking out at that point in time. Now the question becomes, can anybody tell me how much taxes will be 30 years from now?
Impossible.
Yeah, we don't know. Right. So if they go up and somebody's saving money in an account that hasn't been taxed, then that means they're going to end up with less money when they start taking that money out. Right. So we say, hey, Kenny, the employer is giving you 3%, take the 3%, but that other 3%, pay it to yourself, pay it somewhere else. Okay. Get it outside of a taxable account and let's redirect that into a tax-free account. Does that make sense, you guys? Okay. Now for Michelle works out a little bit different because she was putting in 6% with no match. Right. And because there wasn't a match, we told Michelle, hey, look, you can continue to do this. However, number one, Kenny already got one. It might make more sense to take that 6% and reallocate it somewhere else where you can get a little bit more use out of it. If that makes sense, right? Now, so we had her stop her 401k or 403b. All right. And then in terms of savings, they did have $15,000 in an emergency fund. All right. Now, in terms of risk management, they had health insurance. They both had life insurance, but this is what I call a bill. Right. Kenny has this policy through work that he pays for. Does it pay him back? No. Michelle has this term policy that she pays for out of her pocket. Does it pay her back? No. Okay. So that is a bill in my scenario. It's insurance. If something happens, then it will pay out. If nothing happens, the insurance company keeps the money. And that's how life insurance works. If it's this type, if that makes sense. Okay. Not the type I'm going to talk to y'all about, but if it's through work or if it's a term policy, at some point that policy will no longer be there. So the policy's gone, as well as all the money that we put into it, gone. Okay. It's like your car insurance money. You don't see that until you have an accident and you still got to pay a deductible.
I know that's right.
I don't know how they do that. So, all right. But anyway, if we're looking at their goals, they want to retire at age 65. Okay. And they want to be able to keep 100% of their current income. And I swear I've been meaning to change this word from income to lifestyle. Okay. Because we just talked about this 30 years from now. Do you think they're going to be able to buy the same amount of stuff that they can buy today off $90,000 a year?
No.
Nope. Right. So that means if we plan for 90,000, yeah, we might be able to get 90,000, but that don't necessarily guarantee they're going to be comfortable. Right. So we actually want to shoot for a bigger number than that. Right. Because of inflation and all that good stuff. So can we come up with a solution? Yes, we can. And this is what we came up with for them. Okay. All right. Now I don't want to scare everybody because these are a lot of numbers. Okay. So I'm gonna take my time as we go through this. If I'm going too fast, just feel free to just unmute yourself and just say, hey, Brandon, slow down, or can you repeat that? Okay. And if you have to don't not ask any questions, because I'm sure if you have a question, somebody else got the same question. Okay, that's how we learn. We want to make sure we cover as much information as we can. So what we're actually looking at is called a life insurance illustration. And what an illustration is going to do is give us a picture of how this life insurance policy is going to perform based on how much money we put in it, how much money we take out of it, how much money we save, how much the life insurance costs, how much interest we get credited. Right now, are these guaranteed numbers? No. These are all based on averages of actual data throughout the last, we can go back to 1920, 100 years, and look at returns from the S&P 500 stock market. Okay, so our money is credited off of what the stock market does, but our money's not exposed to the stock market. So if the market goes down, it doesn't affect our account, if that makes sense, right? So it's a nice little savings account is how we use this. And so what you're going to see is that in year one, okay, by the end of year one, Kenny's going to put in $60,000 worth of premium. Now, who remembers how much money Kenny and Michelle brought home together after taxes?
90K.
90K, exactly right. And so my question is, if they make $90,000 a year, how can they afford to pay $60,000 of life insurance premiums? They can't. They can't afford to pay life insurance premium. This life insurance policy is going to be different than every single life insurance policy that you've come across. Okay. Because typically when people are buying insurance, they're trying to get the most death benefit for the least amount of money. We're doing the complete opposite. We're trying to get the least death benefit and put in the most amount of money. Okay. That's what we're doing. And so if you notice inside of this gray box here, as this premium goes in, we're showing that it earns about 6% interest or 6% credit throughout the year. All right. That's a combination of this, or what this $60,000 represents is $4,000 a month of Kenny and Michelle's living expenses plus $1,000 a month that they were already saving before I even met them. They were just saving it in the bank at this point in time, right? So that gives us a premium of $5,000 a month that Kenny is paying into his policy. Now, if he does that every month for a year, that's going to give us $60,000, right? Now, in this next column, this is going to show us how much money Kenny's going to take out in his first year, right? And so we can see this is he's going to take out $4,000 or his expenses, right? So he's putting in 5, pulling out 4 as a loan, and then he's saving $1,000 just like he would in a savings account, right? So at the end of the first year, he would have put in 60,000, taken out 40,000, and saved 12,000. Is everybody with me so far? Yeah.
Gotcha.
Any questions? No? Okay. All right.
I had a quick question. How much once they put the loan in, the 60,000, and I mean they put that money in, right? Now how much of that can they take out as far as a loan, right? Is that what you're saying?
Yep. I'm gonna get there. So pretty much to answer part of your question, if they put in 60,000, he pulled out 48 of that 60 that he put in. You got me so far up to that point?
Gotcha.
All right. Now this column here is going to tell us how much total Kenny's going to pay into this account. So I want everybody to think about insurance like buying any other asset, particularly real estate. For example, if you were to go buy a house today, you know exactly how much you want to pay for the house. You know exactly how much the insurance is for it. You know exactly how much the taxes are going to be. You know all those factors going into it. You also know that you're going to be paying into that mortgage for the next 15 to 30 years, right? Because you're purchasing an asset, right? So Kenny told us how much money he wanted to pay into this policy and for how long. So he wanted to pay $12,000 a year into this policy for 7 years. After that, he's finished. He's done. It's paid off is what we're saying. Okay. And so that's what this column is going to keep track of, what he pays into the account. All right. Now, column G is the most important column because this is going to tell you how much cash Kenny can pull out of his account after his fees, after he's already taken out loans. And so what you'll see is in the first year, there's still $7,000 of money that he can still take out on top of the $48,000 that he put in. The reason he can't put in 6 or pull out the full 60 is because of this death benefit. Okay. Now, my question to you guys is, do you think Kenny came to me and said, hey, Brandon, hey, Anthony, I want to buy a life insurance policy and I want an $881,345 life insurance policy? You think that's what he said?
No way.
Probably not.
Hell nah. He ain't say that. Come on now. Right? So you guys remember I said, like, most people buy insurance for the death benefit. So they call up their agent. They say, hey, I want a $500,000 life insurance policy. Can you run me a quote? Right? And so most people are just kind of paying the minimum cost for insurance only. We're doing the opposite.
I'm listening.
Literally doing the opposite. So what we're doing is saying, hey, Kenny, you're putting in $60,000 a year. 48,000 of that is your bill money that you're already paying anyway. What's the minimum IRS requirement to keep all this money tax-free? And based on his age, based on his health, based on his sex, the IRS minimum death benefit for him was $881,345. All right. Now, to kind of dig a little bit deeper, I kind of want to connect those dots because that might not make a lot of sense still. Okay. So we're going to use the real estate example again. Let's say if you had a house, right? Not a house, a multifamily. Told you I'm not an artist, okay?